Rent, car payments, groceries are 3 of your biggest expenses every month. But what if I told you that the wealthy are legally writing these off? In other words, not paying taxes on the money they're coming out of their pockets on these products and services, while you're paying top dollar. In this video, I will show you, yes, you, my beloved viewers, how to turn your everyday expenses into legal tax write-offs, complying with IRS regulations. If you're not executing these tactics, you're leaving cash money on the table. Many people think tax write-offs are only for big businesses, but that's not true. If you have a side hustle, LLC, or any kind of self-employment, in other words, non-W-2 filed income, you may be able to legally deduct part of your rent, car payments, and even groceries. The key is structuring your finances the right way. If you work from home, even part-time, you might qualify for the home office deduction. This allows you to deduct a portion of your rent or mortgage from your taxable income. Want to hear? Here go. First, set up a dedicated workspace in your home. It doesn't even need to be an entire room. For instance, my office space used to be a desk behind my sofa in Howard Beach, New York City. Just designate an area used exclusively, keyword being exclusively for business use. If you use the area for a personal purpose, then it may not qualify. You can also take the home office deduction if you use the section to store inventory or product supplies you use to promote and sell your products and services. You can also write off business use of any part of your home you rent or use as a daycare facility. Next, calculate your business percentage use. For example, if your home office takes up 10% of your home, you can deduct 10% of your rent. Finally, deduct rent, utilities, and internet as part of your home office expenses. Let's say you pay $2,000 per month in rent. If your office space is 10% of your home, you can deduct $2,400 per year. If you own your home, you can also write off part of your mortgage interest, property taxes, and home repairs. If you're a daycare provider who doesn't use your home solely for business, you've got to figure out what percentage of your home you use the business area for daycare. If you want to work with me to ensure you save at least 50% on your tax liability and structure your business to stack generational wealth as high as you want it, join the wait list. The link is in the video description below. Once you sign up, come back and keep watching because I've got more tax slashing tactics for you as long as you watch this video until the end. Next, if you use your car for business, whether it's meeting clients, ride sharing, making deliveries, or driving to a co-working space, you can deduct a portion of your car expenses. There are 2 ways to do this. The first is the standard mileage deduction. In 2024, you can write off a whopping 67 cents per mile that you drive for business purposes. In 2025, it is going up to 70 cents per mile. This works best if you drive a lot for business, not just spinning a block in your whip. It also works when you operate a newer car that requires less maintenance costs. Mind you, when you first put your car into operation for business, you may want to consider using the standard mileage deduction so you are able to use it in a later year if your actual expenses for operating your vehicles were low. The second method is the actual expense method. You can deduct a percentage of tolls, gas, parking, insurance, maintenance, depreciation, and car note interest. This scenario typically works best when your car requires regular maintenance for which you have to pay each year. For instance, if you drive 10,000 miles per year and 5,000 miles off of business, you can deduct 50% of your car expenses, including gas, toll, parking, insurance, maintenance, depreciation, and even lease payments. You may also be able to deduct part of your interest on your car loan. The amount you can deduct depends on how much you use the car for business. For example, if you use your car 60% for business and 40% for personal use, you can deduct 60% of the interest paid on your loan. The IRS will not let you deduct your personal groceries. But if you structure your entity and expenses correctly, some food expenses can be tax write-offs. There are 3 ways to make food expenses deductible. First, the business meals deduction. If you take clients, employees, or partners out for business discussions, meals are 50% deductible, and some can even qualify for 100% deductions. Second, home office snacks and beverages. If you stock food for an office or team workspace, it's deductible. If you work from home and provide food for your business meetings, it may qualify. Third, family business board meetings. If your family members are board members or advisors, you can deduct meeting-related meals. The key is having a real business meeting with documented minutes. And you should have your board advisors sign an advisory board agreement. You should keep this contract in your business documents and entity corporate book. You can even save it digitally on Google Drive or other cloud providers. Let's say you run a family business and hold monthly board meetings. If you buy $200 in groceries per meeting, that adds up to $2,400 per year in deductible expenses. The IRS wants you to overpay, but you can avoid getting jacked by keeping proper records. The most common mistakes people make include, but are not limited to, not keeping receipts and proof of expenses, mixing personal and business expenses, which pierces the corporate veil, and thinking you need a full-time business to qualify. Watch the video you see on the screen right now so you can learn how to reduce your tax liability as much as possible or completely erase it.